Well, it's no secret the economy has been on a roller coaster ride.
But now that there's an upswing, what do you need to know to keep your future secure? Barnum Financial Group's Anthony Truino is back to answer our questions. Anthony, welcome back. Thanks for being here.
Thanks for having me.
We are seeing a little bit of a sigh of relief, you could call it. The market up 60% from what it was last March. So are you starting to see your clients ease a little bit?
Yeah, actually I am. The only problem is I'm not easing as much. I think that people have to remember what has happened. The information that's out there is good but not great. We are stabilizing, but a forward move the way everybody's expecting. We've moved, and if you think about this, March 6th, I believe, was the low. Market was down about 26%. You're up about 23 or 24% today. That's a 49 or 50% range. That's enormous. Sooner or later, I think the optimism stops a little bit, and people are going to start looking at companies' balance sheets and actually what their growth prospects are.
So speaking of stable, what do we really need to know in terms of the climate that we're investing in right now? What are you seeing?
Desiree, the climate it's fragile, and it could swing either way for any reason. So if you get information that comes out that says, hey, listen, we're going to go into a highly inflationary period, you're going to see people start to throw their hands up and scream. Anything can move this, whether it's good earnings, good economic news, bad economic news, anything geopolitical. So you are in probably one of the most fragile economies we've been in a long time, and what you've seen is just pure optimism. You can't make any money in the bank. People have a ton of money on the sidelines, and they're looking for places to put it back in, and you had great values when the market was at 6,500. You know, that's a great time to think about getting in. Now you've moved 60%. You know, I'd tell you, I'm cautious. I would be very cautious to look at what it's doing now.
Yeah, that's your outlook, is to kind of play it safe and be cautious. Are there things that we could do to keep the loss to a minimum?
Absolutely. You always have to take a look. Risk management and all the other segments I've ever been on, I preach it. Understand what you're putting your money into, understanding what the upsides and downsides are. Control your greed, without a doubt, and that's what happens is this market will seduce people to get into it at the top, and then all of a sudden the floor will drop. And they'll say, I don't understand what happened. It's, you know, so risk management, control your emotions, and I think patience being the key. You have 40, 50% more to get back to normal. You have plenty of time to get your money back in to work for you. So I would tell you those three things.
So what do you say to people who say that we should just be buying and holding tight?
It doesn't work anymore, at least in my estimation. I think you have a complete different paradigm shift in the investing world, so I think you still need to have strategic allocation, which is what got a lot of people to build the wealth they have, but I think you have to have a little bit of tactical allocation in there as well, because you have forces and factors that we haven't seen in the past, so you have to be able to hedge your bets, and I think that smart risk management is being able to do that. So I believe that protecting some of your downside will take a little bit of the upside away, but at right now, at this state of the game, I would protect the down more than the up.
All right, you talk about a 2010 Roth IRA. Is it a conversion? What is that? Tell us what that is.
Well, what happens is Roth IRAs right now are restricted to certain income limits, or if you have a Roth 401k, it doesn't matter. But what's going to happen in 2010 is the legislation change, and anybody at any modified adjusted gross income is going to be able to convert to a Roth IRA. That's great because that's tax-free growth and tax-free future withdrawal. So what I would do is if I'm a consumer right now, I'm going to go out and talk to my CPA and talk to my financial advisor, get the two together and find out if it makes sense, because it's not a one-size-fits-all. So just because it sounds like a good idea, it doesn't mean it's good
for
you.
It's not going to work for everyone. But if it does apply to you, definitely
it could be a good idea. Yeah, it could be a great idea. So you get involved with your tax expert and your financial planner, get them together, and they can let you know if it's a good deal.
For young folks that are my age, that are about 22 years old, that are looking to make some different moves.
I'm just going to let that one go by.
Don't you roll your eyes at me, sister. What are some of the quick tips you have for us, U.S.?
Yeah. Keep investing. One of the things that I heard out there, and a lot of it was when the market was plummeting last fall, everybody was saying, you got to get out. My philosophy was get in. And normally when you do the opposite of what the public view is, you're okay. So with your 401ks, with your retirement plans, things that you dollar cost average into, you want to keep doing that, because what happens is you're going to buy some high, some low, some in the middle, and you'll get an average cost. So what I would tell younger folks is be as self-sufficient as possible when it comes to retirement, because you're seeing it with healthcare and you're seeing it with everything else. We have no idea in 20 or 30 years what the retirement plan is going to be for our country. So do it yourself. But dollar cost averaging is a good way to reduce your risk. It's systematic. It forces you to do it. That's the best way.
Plus, when you're as young as Fontaine is, you have more time to play with the market. If you're nearing retirement, though, you should have a totally different strategy.
I agree, and just because you're as young as Desiree doesn't mean,
I love that he plays. I love that he plays along.
Yes.
I would tell you that personally, myself, I'm not a huge risk taker, so I have a very moderate approach. And a lot of people will say that to me, well, I'm 31 years old, I should be aggressive. If you're willing to have those kind of fluctuations in your portfolio, you could very easily take a moderate approach, reduce your volatility, and still become very wealthy, because what people forget is it's making money, but it's also how much can you save. So as you near retirement, depending on what your focus is, or depending on how good of a financial situation is, you need to do what I would call a stress test to your personal balance sheet and figure out it's not what you want, it's what you require. So what do you require at 65 to make your money last to 95?
Not what you want.
Yeah, it's what you require, and that's what people, I think, miss sometimes. Is like, oh, the market's up, and I got to get in. No, listen, you're in a great position. You need 4%. You don't have to take a lot of risk to get 4% and be very comfortable. And that's what I think people have to realize. It's not to me, it's not about what you want. It's what you need.
Yeah, what you require. I like that. How
Thank
about
you,
that?
Anthony Chirino. Listen, if you want more financial advice, you can just contact Barnum Group. You can go to their website or come to ours, WTNH.com, and click on the Connecticut Style link. Anthony Chirino, thanks for being here.
Yes,
again.
thank you so
having me.
much.
Good to
Always a
see you.
pleasure when you're here. Thanks for playing along. Yes.